You don't go broke the day you lose your job. You go broke on a random Tuesday. Nothing dramatic happens. No sirens, no stock market crash, scrolling across the screen. Just a notification from your bank. A credit card payment you forgot about. Rent due in 3 days. A car making a noise it has never made before. Financial collapse rarely feels like collapse. It feels like friction. And here's the uncomfortable truth. Most people who think they're doing fine are 3 bad months away from chaos. Not because they're reckless. Not because they're lazy. But because they're playing a complicated money game with no rules. Minimalism isn't about owning fewer shoes. It's about obeying fewer financial rules. Today, we're going to strip money down to its bare mechanics. No hacks. No productivity theater. Just a small set of minimalist money rules that, if followed consistently, make financial instability mathematically difficult. Not impossible, but difficult. And in a world where inflation hums quietly in the background and algorithms whisper, "Buy now, pay later," difficult is powerful. Let's start with the first rule. Rule 1. Your lifestyle must grow slower than your income. This sounds obvious. It isn't. Imagine you get a raise. 10%. You feel it immediately. A little more breathing room. You upgrade your apartment, or your car, or your subscriptions quietly multiply. The system around you is designed to expand with your income. Landlords price based on what the market can tolerate. Car dealers ask, "What monthly payment are you comfortable with?" Streaming services cost just another $9.99. Individually harmless, collectively permanent. This is lifestyle inflation. And it's not a moral failure. It's structural. As income rises, fixed expenses rise. And fixed expenses are dangerous because they don't disappear when income does. Here's the math no one likes to run. If you make $60,000 and spend $55,000, you feel stable. If you make $90,000 and spend $85,000, you feel richer. But your fragility is identical. $5,000 of margin. That's it. Minimalist rule. One forces a wedge between income and identity. When income rises, spending rises slower. Not never. Slower. That gap becomes optionality. Optionality becomes power. Now rule 2. Cash flow matters more than net worth. This is where public hype and financial reality diverge. You'll hear about net worth constantly. It's flashy. It's scoreboard friendly. This person is worth $5 million. That person hit 7 figures. But stability isn't about what you're worth on paper. It's about what happens next month. You can have a $400,000 house and $350,000 mortgage. You can have $200,000 in retirement accounts and still panic when your checking account dips below $2,000. Why? Because assets don't pay bills. Liquidity does. Cash flow is oxygen. Net worth is potential energy. And potential energy doesn't keep the lights on. Minimalist Rule 2 says, optimize for steady, boring, predictable inflow and controlled outflow. That means tracking fixed costs, knowing your monthly burn rate, understanding how many months of expenses you could cover if income stopped tomorrow. It sounds basic. It is basic. And that's the point. Complexity hides risk. Simplicity reveals it, which leads to Rule 3. Build a shock absorber before you build wealth. This is where impatience sabotages people. Investing is exciting. It feels productive. You're making your money work. But without a buffer, every unexpected expense becomes a crisis. And crises force bad decisions. You sell investments at the wrong time. You swipe a credit card at 22% interest. You borrow from future stability to fix present discomfort. The shock absorber is boring cash. 3 to 6 months of expenses, sitting somewhere safe, not chasing yield, not exposed to volatility. During the early month of the COVID-19 pandemic, millions of people discovered how thin their cushion really was. Jobs disappeared in weeks. Entire industries paused. Those with buffers negotiated. Those without buffers reacted. The difference wasn't intelligence. It was preparation. And here's the irony. An emergency fund earns almost nothing, but it prevents extremely expensive mistakes. That trade-off is minimalist thinking. You're not maximizing returns. You're minimizing fragility. Now we get to a rule that feels almost too simple. Rule 4. If you can't explain your financial system in 5 minutes, it's too complicated. Many people have multiple bank accounts, scattered subscriptions, automated transfers they barely remember setting up, investment apps, side accounts, loyalty points, store credit, payment plans. Each one rational. Together, chaotic. Complexity creates blind spots. And blind spots are where fees, interest, and waste live. Banks understand this. Credit card companies understand this. Rewards systems are built on the assumption that you will lose track. Minimalism demands consolidation, fewer accounts, clear purposes, automations you can explain out loud. Your financial life should fit on a single sheet of paper. Income, fixed costs, variable costs, savings rate, investment allocation. If it doesn't, you're not in control. You're managing noise. Now, let's talk about debt. Rule 5. Only carry debt that increases future earning power or durable assets. Avoid everything else. Debt isn't evil. It's leverage. A mortgage on a reasonably priced home in a stable area can build long-term equity. A student loan that leads to a career with higher income potential can be rational. But consumer debt is different. Credit cards used to smooth consumption. Car loans stretching 6 or 7 years. Buy now, pay later, splitting a $200 purchase into manageable illusions. The average credit card interest rate in the United States has hovered around 20% in recent years. That's not a small tax. That's gravity. At 20% interest, a $5,000 balance can take years to eliminate if you only make minimum payments. You're not buying convenience. You're renting it at a premium. Minimalist money rejects high-interest consumption debt, not because it's immoral, but because it compounds against you. Compounding is neutral. It works for whoever owns the interest stream, which brings us to the most misunderstood rule. Rule 6. Invest simply and stay invested. There's an entire financial entertainment industry built on complexity. Hot stock picks, sector rotations, secret strategies. But zoom out. Over the long term, broad equity markets have historically trended upward despite wars, recessions, bubbles, and crises. The exact path is chaotic. The direction, over decades, has been remarkably consistent. Consider the S&P 500. It has experienced crashes exceeding 30% multiple times. Yet over multi-decade horizons, it has delivered substantial cumulative growth. The uncomfortable part? Most people don't fail because markets fail. They fail because they leave. They sell during panic. They chase during euphoria. Minimalist investing says, choose broad, low-cost exposure. Automate contributions. Ignore the noise. It's boring. It's repetitive. It's powerful. And here's the math most people underestimate. If you invest $500 a month at an average annual return of 7%, after 30 years you don't have $180,000. You have over $600,000. Not because you're brilliant, because time is. But that only works if you stay in the game, which requires Rule 3's shock absorber. Everything connects. Now, let's confront a hidden mechanism most people never see. Inflation. Inflation is subtle. It doesn't knock. It erodes. 3% inflation cuts purchasing power in half over roughly 24 years. That means the money sitting idle is slowly shrinking in real terms. So minimalist money balances two forces. Too much cash and inflation eats you. Too little cash and volatility destroys you. Stability lives in the middle. And this is where public hype diverges from reality again. Social media shows extremes. Early retirees in their 30s. Crypto millionaires. Day traders posting screenshots. What you don't see are the thousands who tried and disappeared quietly. Financial stability is not viral. It's invisible. You won't get applause for maxing out a retirement account. No one congratulates you for not upgrading your car. Minimalism is socially unrewarding in the short term. But here's the long-term implication. When your fixed costs are low, when your debt is controlled, when your savings rate is consistent, when your investments are automated, you gain something rare: time flexibility. You can leave a toxic job without panic. You can negotiate instead of beg. You can wait out downturns. That optionality compounds psychologically. There's a subtle shift that happens when you no longer fear the next bill. Decisions become strategic instead of reactive. And yet, even here, there's a risk. Minimalism can drift into stagnation. Some people become so focused on minimizing expenses that they neglect increasing income. They optimize small leaks while ignoring large opportunities, which leads to Rule 7. Protect your earning engine. Your ability to generate income is your largest asset, especially early in life. Skills, reputation, adaptability. Markets change. Industries automate. Entire roles disappear. Think about how quickly retail shifted when companies like Amazon scaled logistics and convenience. Entire shopping habits transformed in under a decade. Stability doesn't mean resisting change. It means staying employable within it. That might mean continuous learning, strategic career moves, expanding networks, quietly building leverage. Because even the best minimalist financial system collapses if income permanently declines. Now step back. We've stripped money down to a few core principles. Spend less than you earn and widen the gap. Prioritize cash flow over vanity metrics. Build a shock absorber. Eliminate toxic debt. Invest simply and consistently. Balance liquidity with growth. Protect your earning power. Notice what's missing. No exotic assets. No complex derivatives. No constant optimization. Minimalist money isn't about maximizing upside. It's about minimizing the probability of ruin. And that phrase matters. In finance, ruin is asymmetric. If you lose 50% of your money, you need 100% gain to recover. If you lose your job with no savings, you don't need motivation. You need cash. The system we live in encourages consumption. GDP grows when people spend. Advertising exists to create dissatisfaction. Credit exists to accelerate desire. Your stability does not increase GDP, which means the broader system is not designed primarily for your long-term resilience. That's not conspiracy. It's incentive alignment. Banks profit from interest. Retailers profit from turnover. Markets profit from activity. Minimalist money reduces activity. It's almost rebellious in its restraint. But here's the final tension. Even if you follow every rule, uncertainty remains. Markets can stagnate for years. Inflation can spike. Health crises happen. Policy changes alter tax structures. Stability is not immunity. It's probability management. You are stacking odds in your favor. You are widening margins. You are reducing fragility. But you are not eliminating risk. And maybe that's the most honest part of this entire conversation. Financial stability is not a destination you arrive at and lock behind you. It's a posture, a set of constraints you choose repeatedly. Every raise tests Rule 1. Every market drop tests Rule 6. Every shiny purchase tests Rule 5. The world will continue to get louder, faster, more optimized for impulse. The question isn't whether you can outsmart it. The question is simpler. Can you tolerate being boring long enough to become stable? Because in a culture obsessed with acceleration, the most radical financial move might be subtraction. And if you remove the noise, the upgrades, the debt, the complexity, what would your financial life look like then? And more importantly, what would it stop controlling?